29.14.03. Resistance on the upside at 70, 80, 94, 39.03, and 12. Pivot 38.62. Support at 54, 41, 29, 14, 03. Resistance on the upside at 70, 80, 94, 39.03, and 12. All right, welcome to some of the new folks that are here. We are trading mini S&Ps, looking for opportunities to scalp the market. We're not trying to hit home runs and go for the whole range of the day, even though sometimes our support and resistance is a whole one. Some of them match up for the whole range of the day, but we don't know that. I wish I could tell you that's going to happen. But we're trying to scalp the market for 3 or 4 points, and that's dependent on the volatility. But I think right now with the market the way it is, at least for this morning. Now, if you're going to trade later this afternoon, it's a whole different ball game. We have the FOMC results from their meeting, and they're going to dictate what interest rates are going to do. Consequently, the situation there is going to be very volatile because obviously that's what the market is gearing its trade on every day. So you would have to be a little bit patient there. And as we come down here to our 54 area, you have to be a little bit patient there and trade it with a little grain of salt. And my advice would probably be not to trade at all, only because it just doesn't seem like it's I don't know. It's just not. It's not always advantageous for us to be trading on those volatile kind of days because we're just at odds with the ability to keep in track or balance with those algorithms that are out there. Very difficult to trade those algorithms when they are, going off really quickly as we kind of flow through our 54 area here. Again, make sure you keep your stops in place. We're always talking about keeping our stops in place because that's what we have to do here. We are not going to love any of these trades. Not for sure not. Consequently, we keep our stops in place and always look for a next opportunity. If it's a little bit too close to the opening here, then we just kind of wait a little bit. And we always talk about the first couple bars being exceptionally volatile and moving around very quickly, only because some of these traders are getting in, they're starting to trade the overnight stuff, and they're setting up their positions. So our repeated levels again, our pivot this morning is 38.62. Support kind of ran through here to 54. The next level on the downside is 41, 29, 14, and 03. Resistance on the upside at 70, 80, 94, 39.03, and 12. All right, so we came through here 54 really quickly there, and again, that always warn you about the first bar of the day, very volatile, and could go both ways. Sometimes it works our way, and sometimes it doesn't, and you just have to don't guess as to which day you're going to trade or not. Just either decide one way or the other. Are you going to trade the first bar or two or not? And that's really it. So, all right. Market continues the downtick here. Again, you can see how range bound it was overnight, not really doing too much. And kind of settled in. If you look at the chat now, you'll see the levels that we gave out this morning. They are up there for you as a guide to the day, right? We're using as a guide. We can add to them, subtract from them. We can tweak them a little bit. We can warn you that, nothing's etched in stone. Just keep that in mind as we're trading. Traders think that because you have a stop and an entry point that's it, and there's no adjustments to that. That's not necessarily the case. Bond market really did drift higher yesterday, as I think concerns about today's decision was weighing on the bond market. I mean, they rallied very nicely. We talked about the rally in the bond market there over the last few days. Yield yesterday was well below the 4% range. and it is up at 404 on the yield right now. So obviously today's FOMC announcement later on this afternoon at 1 o'clock is going to be the focus of the market. They could maybe, guess as to what's going on, and you're going to get some volatility on that end. Again, if you don't like that volatility and it's a little bit, just kind of, you don't have to trade, right? We always talk about, choosing when to trade, right? It's not only, there's also that aspect of trading is waiting for opportunities, and then knowing if you don't trade when there's a number, you don't trade when there's obviously FOMC, because F days are terrible. I mean, you can try to outmaneuver those algorithms, but you're going to have to take a lot of risk to try to outmaneuver those algorithms. So highly suggest, to throttle back on trading. If you can watch it, I mean, if you can watch your ladder ticket go crazy, then go for it. Otherwise, just sit back, and we're going to trade the after effects tomorrow. So it's always the case with the on F days. And F days doesn't only have to be when they release their announcement on interest rates. It could be when one of these Fed governors are talking, right? Another jumbo rate hike from the Fed is on tap for this afternoon, with the central bank likely to announce a fourth 75 basis point move of the year. The hike have so far added 3 percentage points to the federal funds rate in 2022, which now stands between 3 and 3.25, and an increase today would bring it to close to 4% mark. That was the last time delivered in 79 to 80, between 79 and 80. The Fed is also predicted to announce another hefty increase in December to set a new record, though many are debating whether it will signal a downshift in its aggressiveness. And that's what everybody's going to be focused in. Not so much so that the rate hike is going to be 75 basis points, but rather the language of the announcement, and then followed by the Q&A a half an hour later. Traders are divided whether a Fed 75 basis point hike or a 50 basis point hike will happen next month. So pay attention to Powell's press conference at 1:30 Chicago time, which is a half hour after it's released at 1 o'clock. Strong household balance sheet, which have higher savings due to government pandemic relief programs, may instead lead the central banks to stay on its current aggressive path, resulting in a higher terminal rate than has previously anticipated. On the other hand, weakening labor demand, declining rents, an earnings season that is showing signs of fragility could provide early signs that the economy is weakening and cause the central bank to tap on the brakes.